So what I would say is it's fair to say last week in our March meeting, that was, I think, an important milestone in evidence accumulation. So in our March meeting last week, we were able to look back and to see that the disinflation process has been ongoing. We've continued to make progress. We continue to move towards our 2% target. So absolutely, a lot of evidence is accumulating. But what's also fair to say is that the transition from this holding phase, we've been on hold since last September after a substantial hiking cycle, is we do have to, I think, take our time to get that right from moving from holding to dialing back restriction. So it's clear that we've a lot of confidence. A bit more data will help us to build sufficient confidence in the coming weeks.
Disinflation, but not down to the 2% target yet. Is there a danger that in this last mile, this key last kilometre or so, I should use kilometres, we're talking about Europe here, that actually the central bank goes too far, too fast, given the fact that even this morning I was looking at Spanish data and it's still got a core level, got a 3 handle?
So there remain open questions, and that's why, if we were totally convinced, totally confident, the discussion would move along more quickly. So there remain open questions. And I think what's true is that at the start of the year, January, February, there are kind of turn of the year dimensions to the data. And we need to see that settle down a bit. So again, I think we have a very good process to analyse the data, to make projections. So we have a fairly stable view that we are on our way back to 2%. But I think we have the time to, if you like, validate that, to see some more confirmation, especially, as you say, in those segments. It's not so much overall core inflation, I think, but in the services component, we do, I think, have some time to see further validation, because it's important to get that initial transition away from holding towards starting back restriction, to get that right.
Yeah, I spent most of this year trying to work out what Monsieur Villore de Gallo's interpretation of spring is. When I was talking to him in Davos, he was a little bit more vague on the timing. Now he's saying spring looks like it could be the right time for a cut. But that doesn't mean April, does it? Does it mean June is more likely?
Well, as a technical economist, this all sounds like Q2 to me. So Q2, I think, but from a macro point of view, Q2, we think in quarters from a macro point of view. So I wouldn't overanalyze April versus June. I think Q2 is a time when we will be far enough into 2024 to see more of the wage dynamic, to see more of the price pressures. So we will learn some more by April, we will learn a lot more by June.
I hear what you're saying. So we learn a lot more by June. And again, as the introduction, which you didn't hear to this segment, was talking about Mr. Stornaras saying, look, we need to go, I think, pretty aggressively. He was talking 1 in June, 1 in July, then you get your lovely break, and then 2 more by the end of the year. Does that sound a little bit too much to you, given the evidence you will have?
Yeah, so I think it's very important, especially for me in my role, to make sure that we avoid trying to provide calendar guidance to the market. I think we have a good framework for making decisions where we emphasise what we see in the inflation outlook, what we see in underlying inflation, and what we see in the strength of monetary transmission. On all of those dimensions, we learn meeting by meeting. So I'm not going to try and forecast the rest of this year or next year. The market does that. The analyst community does that. I'm sure you talk to them. Yeah. But from our point of view, we have to go decision by decision. And it's for me, I don't think I should look beyond the next meeting or two. So again, what I would say, absolutely, we will, once we are sufficiently confident that we will get back to target in a sustainable manner, in a timely manner, that's the right time to move to the next phase.
I can't help thinking, from everything I've listened to from the market and indeed from the ECB, and dare I say it, from the Bank of England and others as well, the labour market and labour market wages is key. Whether I'm talking about the BOJ with their Shunto round or whether I'm talking about the ECB as well. Are wages concerning, or are they actually moving in the right direction?
So what I would say is we think they're moving in the right direction, and what I would say the Friday data about Q4 what was essentially reinforcing that view. But because the economics of this remain open, it remains open about how quickly will wages decelerate. Wages were not the source of this inflation problem, but in terms of making sure we get back to target, the interplay between wages and profits, our forecast is built on a degree of wage deceleration, but it's important to say we need to see workers' real incomes improve to rebuild not just this year and the year after. So we allow for higher than normal wage increases, but we also need to see essentially firms absorbing a fair amount of that in lower profits. Profits were quite high in 2022. There is some room for profits to come down, and that is part of the open questions we have.
I've been listening to you speak for the last hour, and I'm not going to divulge any of that because it was all Chatham House. But it's fascinating. What did come up in the conversation, I wonder if you'd expand upon, is the difference between Europe and the United States. Everyone's kind of bracketing the UK, Europe and USA. We're all going to go. Who's going to go first, my view? But there are some subtle dynamic differences, which I think you're probably keen to address.
Well, I think, of course, we've had many commonalities. But what's also true, of course, for us, let me focus on the European situation, which is we've had the European economy grow in a very weak way in the last number of months. What we are going to be looking for, we need to see, is a pickup in the European economy. We think as real incomes go up, wages improve. We also think that as the world's kind of trade normalizes after a lot of pandemic gyrations, that European exports will pick up. So what I would say is, in terms of one of the obvious differences on this side of the Atlantic against the other side of the Atlantic is that growth environment. We need to see a pickup in growth rates, which is not exactly the same question the Fed is facing.
I'm going to try and squeeze in 3 more questions because we've already gone about 6 minutes. Well, is the mandate of the ECB compared with the mandate of the Federal Reserve, is that hamstringing you potentially because they have a dual mandate and you have a very primary mandate? Well,
I mean, I think for everyone around the world, that clearly, until inflation is more or less a target, the kind of other considerations, we have secondary objectives, so we do have other considerations. So, of course, we look at the real economy as well. But, you know, until inflation is really firmly on the way to target, we do have a kind of primary focus. But, of course, it's in no one's interest for inflation to remain away from target. So I don't think there's any trade-off there.
You're trying to conduct a monetary job, and at the same time when fiscal largesse is going to be absolutely challenged like we haven't seen for a long time. We look at the broader balance sheet of individual countries, they're under a lot of pressure as well. Do you have concern that those fiscal constraints are going to actually mean that you're going to have to move more aggressively because, of course, that boost to the economy is just not going to be there again?
So how we operate is we take into account the announced fiscal policies, of course, of the European governments. So what we have this year is, of course, a plan essentially where a lot of the temporary measures that were introduced when energy prices were sky high essentially expire. So we do see some reduction in fiscal stimulus this year, but essentially then it's relatively stable for the next couple of years. So that's what our forecast is built on. I'm not going to try and forecast where European fiscal policy will go. But under that baseline, where essentially we don't see a dramatic narrowing of fiscal deficits, we don't see a widening of fiscal deficits, it's a fairly stable fiscal path. That's what the forecast is built on.
Just want to ask you about your operational review yesterday. I mean, I think for, dare I say it, economics wonks, there was a lot in there. I thought it was very interesting. Was there a mea culpa in there that actually the policy of large-scale bond buying did not achieve its goal in its entirety?
So I think let's not mix up our apples and oranges. So the debate about QE, about bond purchasing, I think we have to have a different conversation about that versus the operational framework, which, as you say, is a technical topic. So what I would say is important we did this review, because absolutely, when we are away from the lower bound, we reduce the size of our balance sheet. We stopped QE. The TLTRO program is rolling off. So the operational framework review, if you like, is to make sure how we implement monetary policy is stable, even when the balance sheet is in a shrinking mode, which it is. So I think it was important to do this, but I would kind of plead to keep it entirely separate from any discussion about the pros and cons of QE.
We're running up against the end of time here, though. But is there an admission, actually, there is a different mechanism to boost the liquidity in markets, to boost economic activity, to support economic activity than what was previously done? Ergo, why would you have the change otherwise?
No, I think there's no linkage between those debates. It's just a technical plumbing issue.